Welcome to today's explainer. Look, right now, there's a totally chaotic situation unfolding in the global financial markets. If you've been watching the charts even a little bit lately, you've probably noticed that gold, the historical bedrock of wealth, is behaving in a way that is leaving investors absolutely bewildered. $10 trillion. That is how much wealth has literally just been wiped out from the gold market recently. We're talking about a massive 22 to 23% fall in gold prices. I mean, if you're an investor, seeing a drop like that is definitely more than enough to instantly validate any anxiety you might be feeling. It's this massive evaporation of wealth, right? And it forces us to confront a really critical mystery. Okay, let's dive into this. Because when an asset class that is historically as stable as gold loses that much value, you really have to wonder, is the golden era just over? Has gold totally lost its attractiveness to the modern investor? Or is there actually a massive structural bull run hiding right there in the shadows? Stick with me here, because the logical answer to this question is going to fundamentally change how you view your portfolio. Part 1. The domino effect. Why exactly is gold falling? So this whole massive shift really started with rising geopolitical tensions, specifically the onset of the war in Iran. This sudden instability caused oil prices to just absolutely spike. And while, as we all know, when oil goes up, the risk of widespread inflation spikes right along with it. To combat this inflation risk, central banks around the world were basically forced to act, either holding interest rates high or hiking them even further. And this environment created a huge shift. Investors started tactically moving their money, which led to massive outflows from global gold ETFs, because they were shifting their capital out of gold and into what they perceived as safer asset classes. And it's not just the big financial institutions pulling back. Everyday consumer behavior is totally mirroring those institutional ETF outflows. Over the past year and a half or so, we've seen a rapid, undeniable decline in the demand for physical gold jewelry. So you've got institutional money flowing out and retail consumer demand dropping at the exact same time. It creates this compounding negative effect on the surface that frankly looks pretty grim. But you really need to understand one absolutely crucial thing. This is just a temporary phenomenon. If you're a focused learner paying attention to the broader macro picture, you need to recognize that this surface-level panic is honestly just a distraction. It's noise. To understand the actual structural phase of the market, we kind of have to stop looking at the panicked retail investors and start looking at the real heavyweights. Which brings us to part 2, smart money, what central banks know. Let's move to and see how this builds, because recent data from a Global Gold Council survey reveals a massive stabilizing factor. A staggering 95% of central banks are actively looking to increase their gold reserves. I mean, really think about that for a second. While ETFs are seeing these huge outflows and everyday retail buyers are hesitating, the absolute biggest players in global finance, the central banks, are quietly stockpiling gold. This massive institutional backing is basically the foundation of a hidden structural bull run. So why are they buying? Well, it all comes down to de-dollarization. This is the growing global trend of reducing reliance on the US dollar for international trade and foreign reserves. And it's a massive macroeconomic risk that is fundamentally reshaping global finance as we know it. Central banks aren't just buying gold for the fun of it. They're hoarding it to protect their foreign reserves from the growing risks of relying too heavily on the dollar. It's a calculated defensive maneuver on a truly global scale. And this brilliantly illustrates the core conflict happening in the gold market right now. The temporary phenomena, like those ETF outflows and the falling jewelry demand, is just short-term panic. Like I said, it's noise. But the structural bull run, that 95% central bank backing driven by de-dollarization risk, well, that's the smart money. The short-term indicators might be flashing red, but the long-term structural foundation of gold is literally stronger than it has ever been. Part 3. The final verdict. Is it time to buy? So the crucial point is this. The analysis clearly concludes that the long-term bull run for gold remains completely intact. That recent 22 to 23% fall we talked about earlier, that's just a temporary dip, which means gold values are currently heavily discounted. Honestly, mirroring the central banks by raising your own portfolio's gold reserves is a really smart defensive play right now. And taking action is highly accessible. By downloading the MySip online app, digital gold is readily available, allowing you to start building your position from just 100 rupees. I'll leave you with this final provocative thought to consider today. You've seen the data. You understand the surface-level noise versus the actual structural reality. So will you let a temporary dip scare you out of the market, or will you take advantage of this massive discount and invest like a central bank? The choice is entirely yours. Thanks so much for joining me for this explainer, and I'll see you next time as we continue to decode the world's most fascinating subjects.